Welcome. Today we're doing a deep dive into the Q3 2025 results for DSV. This follows their earnings callback on October 23rd. And, this isn't just about the numbers. It's really about how management pulled off something pretty remarkable. They've accelerated the integration of Schenker, the biggest logistics deal ever, really. And they did it while the global economy seems to be, getting worse. So our mission for you today is clear. We want to distill those key financials, break down what management said, and critically understand what exactly sparked that immediate, really strong rally we saw in the stock price right after the call.
Yeah, that strong market reaction, that's the big story here. Look, this quarter was always going to be about execution quality. It was a real test of DSV's integration skills, and the market clearly liked what it saw. They delivered operationally where, frankly, others might have stumbled, especially with such a murky macro picture out there.
Okay, let's unpack this then, starting with the headline numbers, because there was a fascinating split, wasn't there?
Absolutely. You saw the top line, the revenue, it actually disappointed a bit.
Yeah.
Came in at DKK 71.983 billion, which missed the consensus forecast of DKK 74.9185 billion. But that miss was pretty quickly overshadowed by the metric everyone was watching. EBIT before special items, or EBIT BSI, that landed at DKK 5.434 billion.
Right, and that comfortably beat the street's number, which was around DKK 5.32 billion, correct?
Definitely. Comfortably ahead. So miss on revenue, beat on profit.
Still, we should probably acknowledge the scale. Even missing consensus that year-over-year revenue growth was massive, something like 63% up.
Oh yeah, huge jump. That just shows you the sheer size of the Schenker business now hitting the books, being fully integrated from an accounting perspective.
And the quality of those earnings looks solid, too.
Impeccable, really. Free cash flow was very robust at DKK 4.276 billion, and that translates into an excellent cash conversion ratio, 96%.
96%, okay.
Yeah, and for you listening, that ratio, meaning 96 cents of every krona of operating profit, turned straight into cash. That's the bedrock of their whole post-acquisition plan. Strong cash generation is just essential for hitting those deleveraging targets fast.
Right, paying down the debt from the deal. That sets us up perfectly for the real story here. The integration narrative. Management didn't just meet the plan. They seemed really focused on how much faster they're moving with the Schenker combination.
Precisely. And the key financial bit here is the raised synergy target. For the full year 2025, they now expect EBIT synergies to be around DKK 800 million.
Okay, 800 million. That's up significantly from their old range, wasn't it? Something like 500 to 600 million.
Yeah, a big jump. About a 33% increase on the midpoint. And they also confirmed DKK 300 million of that boost was already banked in Q3 alone. So they're harvesting those savings immediately.
And the pace update itself was, pretty incredible. They originally thought they'd be maybe 15% done with the full integration by the end of this year, 2025. Now they're saying, double that? 30% complete by year end?
Doubled it, yeah. And looking out to 2026, the projection for integration completion went from 50% up to a much more ambitious 70%. So pulling everything forward.
Well, it's fascinating. Isn't just the speed, though, right? It's a qualitative stuff they shared, too.
Exactly. Management reported very little attrition among customers. They put this down to a really structured, proactive approach. They were actively talking to clients, explaining the merger's benefits before the integration actually happened in their specific market. And that seems key to minimizing those dis-synergies, basically, losing customers because the merger gets messy.
Okay, wait, I have to push back just a little there. Very little attrition sounds great, but how confident are we that customer loyalty is really locked in? I mean, they just announced pretty big job cuts, over 3,000 people.
White-collar roles?
Right. And the huge German market integration is still coming up in January.
Yeah.
Is that loyalty maybe still a bit fragile?
That's a critical question, absolutely. The market reaction suggests confidence for now, but yeah, the integration challenge is still massive. They did confirm the hard numbers. Over 3,000 white-collar roles reduced directly because of the combination. But the argument is that the structured rollout helps manage that risk. They're already live on the combined systems in 13 countries now. That suggests, maybe they've worked out some of the early kinks.
Okay, so those 13 countries are kind of the test bed.
Exactly. And they expect Germany, obviously a huge and complex piece, to go live pretty seamlessly on January 1st. The success in those first 13 gives them and the market reason to believe that structured plan is actually working.
And just to put a pin in the long-term potential here, the goal for the full 2026 EBIT synergy impact, that's still pegged at that massive DKK 4 billion number, isn't it?
Still DKK 4 billion.
Right.
But the point is that number is looking substantially de-risked now because of this faster pace they're demonstrating.
Okay, so we know how the integration is tracking faster than expected. Let's pivot now to the operating reality.
Yeah.
Looking at the divisions, we see big growth contributions, but also some, well, operational headwinds from the slowing economy.
Yeah, let's start with contract logistics, CL. That saw really impressive growth. Delivered EBIT of DKK 1.1 billion, which is up 73% year over year.
73%.
Huge. And that was significantly boosted by inheriting Schenker's massive physical warehouse footprint and their competence there. But management did flag a specific area they're focusing on.
Okay.
They need to increase the return on capital deployed in CL. They actually said the current level is unacceptable.
Unacceptable. Why? Is the problem that Schenker historically owned too much real estate, too many assets, so they inherited capital-intensive stuff that isn't generating enough profit yet?
That's precisely it. That high growth came bundled with inherited capital intensity. DSV's model, famously, is asset light. So to get that 73% growth, they absorbed this big capital-heavy operation. Now they need to optimize those assets. That means either, sweating the existing assets much harder to make more money, or eventually selling off non-core heavy real estate, which is actually a theme we'll come back to.
Got it. Okay, meanwhile, Road also looked pretty good. DKK 798 million in EBIT, up 55% year over year.
Road performed well, yeah, but it has its own issues, seasonal and structural. Management pointed out that while the combined road network is working, seasonality is going to hit Q4.
How so?
Specifically, high fixed costs combined with fewer production days in December. That usually pressures margins. They also mentioned needing to right-size infrastructure locally in some places where volumes haven't quite met expectations.
And we also heard about a productivity challenge, this time in Air and Sea, A&S. Sounds like a tricky one tied to the economy.
It is. Management explained that because of the general economic slowdown, the average transaction size is shrinking. So think tons per air freight shipment or TEUs per ocean container booking.
Right. TEU being the standard 20-foot container unit.
Exactly. So if the amount of cargo per shipment or per container gets smaller, which is a classic sign of an economic slowdown, your employees end up having to handle more individual shipments just to move the same total volume.
Which means more work, more handling.
More handling, higher operational cost per unit of volume. It puts immediate pressure on your productivity ratios and your conversion ratios, how much gross profit you make per shipment. It's a short-term margin squeeze, basically.
Okay. And what about yields, the pricing? Particularly in ocean freight, which sounds like the toughest market right now. They mentioned legacy Schenker yields were down more than DSV's. Why is that?
Yeah, ocean is tough. The disparity came down to a legacy strategic difference. Apparently, Schenker traditionally was longer on the procurement side, meaning they tended to lock in contracts for ocean shipping space further in advance.
So when rates started falling off a cliff.
Exactly. When ocean rates began that steep decline we've seen, holding those longer-term, potentially higher-priced contracts became a real headwind for Schenker's legacy business. DSV is now trying to mitigate this across the board by focusing more on LCL.
Less than container load.
Right, where you bundle lots of small shipments into one container. That usually carries higher margins per shipment. Plus, focusing on various value-added services, it's all about protecting the overall gross profit, even when the headline rates are collapsing.
Okay, so putting it all together, accelerated integration, strong cash flow, great synergy progress. But these simultaneous macro pressures hitting productivity in the core divisions.
Yeah.
What does this mixed bag mean for the outlook? DSV narrowed their full year 2025 EBIT guidance, right, to DKK 19.5 to 20.5 billion.
They did. And this raises that critical question you touched on earlier with the synergy beat. Why just narrow the range? Why not raise the top end?
Yeah, exactly.
Management put it down squarely to those persistent macro uncertainties. They cited two main things. First, a pretty significant FX headwind, impacting EBIT by roughly DKK 500 million.
Okay, 500 million from currency isn't trivial.
No. And second, volumes are now declining, tracking below their initial expectations. Remember, they previously thought volumes might actually grow this year. Now it's contraction.
Okay, 500 million FX hit is real, but is management maybe using macro uncertainty just a little bit as a convenient shield here? Could they be building in some buffer, maybe being cautious about Q4 integration steps?
Well, look, it's definitely prudent management, but they did make a strong case that the FX impact wasn't discretionary, The guidance suggests they're trying to balance the clear wins on synergies, which are things they can control against these external pressures like currency and slowing global trade, which they can't control. The ultimate goal they kept emphasizing is driving earnings per share, EPS growth.
Right. And on that note, with the strong cash flow and that big deleveraging number, DKK 4 billion debt paid down just in Q3, they hinted that capital returns, specifically share buybacks, might come back sooner than expected. Within a couple of quarters, I think was the phrase.
That was the phrase. And yes, that's potentially a huge acceleration. The market was previously thinking maybe H1 2027 before buybacks might restart. So this really highlights how well that cash machine is working.
And there's another piece to this capital return story, isn't there? Something about real estate.
Yes, a really interesting strategic detail. Management confirmed they are actively looking at selling off the legacy Schenker real estate portfolio. This fits perfectly with DSV's long-term asset-light strategy.
Okay, and do we have a sense of the value tied up in that real estate?
The estimate floating around is roughly 1.5 billion. That's about DKK 11.2 billion. And crucially, they stated this potential windfall is not currently baked into their existing synergy plan.
So it's extra, on top of everything else.
Exactly. It represents this clear, uncounted, and pretty massive capital allocation option. It could rapidly accelerate their ability to return cash to shareholders way ahead of that previous H1 2027 thinking.
Right. We've distilled the data, dug into the details. Now let's try to apply it. We turn things over to our high-stakes investment committee for their thesis, starting, of course, with our usual very important disclaimer. This is not financial advice.
Okay. The thesis. Synergy arbitrage and hidden capital.
Right, break that down. What do you mean by synergy arbitrage?
I think the market is fundamentally underappreciating just how quickly and how certainly this integration is happening. That DKK 4 billion EBIT impact targeted for 2026, it's not just a hope anymore. It's becoming highly de-risked because they're on track to hit 70% completion way ahead of schedule. The arbitrage opportunity, as I see it, is recognizing that the market might still be treating those synergies as somewhat potential, maybe risky, when management is actually turning them into reality at record speed.
So the outrageous but plausible pitch.
It's this. You execute a long position in DSV. You're essentially betting on best-in-class execution, that superior cash flow generation, and a management team laser-focused on the EPS playbook. And you could potentially fund that long position by establishing a short position in a peer company, specifically one that's clearly struggling with capacity issues or is resorting to deep cost cutting purely because the cycle is turning down, not as part of a transformative M&A integration like DSV's.
That's a key distinction, isn't it?
Yeah.
DSV is restructuring and cutting costs to achieve integration gains, specific synergy targets. Others might just be cutting because the market's shrinking.
Precisely. DSV's management is executing a very focused playbook. Others are just reacting, trying to survive a softening cycle. And then you have that DKK 11.2 billion potential real estate windfall. That provides a pretty substantial hidden floor under the stock valuation, and it offers a clear pathway to accelerate capital returns much sooner than people expect. It makes DSV look like a cash compounding machine that maybe the market hasn't fully priced in yet.
Okay, so to quickly wrap up this deep dive, we saw an EBIT beat, despite revenue missing forecasts. This was largely driven by that accelerated Schenker synergy capture and really strong cash flow, which clearly fueled the market rally. The focus now shifts completely to management's ability to deliver that increasingly de-risk DKK 4 billion in 2026 synergies, and also to successfully unlock that hidden DKK 11.2 billion in real estate value.
Yeah, the key takeaway for you listening, regardless of how you invest, is that this earnings call really hammered home a fundamental point. In a volatile, slowing economic environment, it's the execution quality and the mastery of integration that truly separates the winners from the rest. That immediate positive market reaction, it was basically a validation of DSV management's very detailed, very structured strategic playbook.
Thank you for joining us for this deep dive. We'd encourage you to keep thinking about the strategic implications here, especially how that timeline for capital return could shift even further if that real estate sale happens quicker than anticipated.